Are you concerned about managing risk in these volatile markets? Well, AJ Monty has a 1% rule for you. Let's talk to him now. Hi, how you doing?
Good, thank you.
And now let's right away jump into this. You know, the markets are very rocky. Everybody's worried. Some people want to sell. Some people just don't want to pay attention to the markets. You have this little technique that you think is helpful to people, this 1% rule. Could you explain that?
Sure. It's worked for me for over 30 years now. I started trading commodity markets in the World Trade Center, trading gold and silver.
Oh, right.
So a lot of the professional traders, even if you speak to them now in these volatile conditions, will tell you that the key to success is not so much picking the right investment, it's knowing when to get out when that investment goes against you. So what I've done is I've embraced the 1% rule. It's something that's actually been around for a while. I can't say that I came up with the formula. It's just something that's worked. I don't think anyone's actually claimed it, but we've modified it to the point where it's easily calculated and could be used by virtually anybody, whether you're a professional money manager or just a private investor or a trader for your own account.
So how does it work? I mean, you sell when it's 1% down?
Yeah, well, here's I'll use a model account of, let's say, $100,000.
Okay.
You have a $100,000 account.
Right.
You take 1% of that, which is roughly $1,000.
Right.
And that, if I were to put that in a simple statement, would state, whoever the trader is, will not lose more than $1,000 on this particular investment, and that's calculated per position.
Okay, so all right, so I understand now. So let's say you have 10 positions in that account,
Yes.
right? And each one is $10,000.
Well, that would be $1,000 per position. So if you have 10 positions, you're not willing to lose more than $1,000 per position.
I see.
So if you're wrong, now if you're wrong on all 10, you're going to lose $10,000 if you're doing it correctly. Right. And if you're wrong on all 10, you need to talk to me because you're doing something wrong with the stock selection.
Change your portfolio.
Right.
Yeah. Okay. So essentially, what you're talking about is that you limit the risk on any one. You're limiting the risk on any one position, but you're setting a dollar amount of it as a percent of your whole portfolio.
Yes. Right? Now that's where it starts. So the $1,000 is determined to be the risk amount. That's the 1% per position. But there's more to the formula than that because we need to look at a technical chart to determine where support level is for that stock because you have to now determine what your risk per share would be. So let's use another example.
Why are you making it more complicated? The 1% is so simple for people to follow.
Well, because if you're buying a stock and you're stopping yourself out at a 1% per account, you might find that your stock is going to go 1% against you in the value of your account, not share price, but 1% against you, and then all of a sudden it hits support and goes off and you get stopped out and you never should have gotten sold out. So let's say you have a $40 stock that you want to buy. Let's say that you buy 1,000 shares of that $40 stock, so you spent $40,000 of your portfolio. Right. Again, this is an example. Right. If we determine that the support level for that stock is at 39, you bought it at 40, support is at 39, you're going to want to put a stop loss order somewhere below support. Okay. So let's say you put that stop loss below 39 and you set it at 38. Now your risk amount is $1,000, but the risk per share is now $2 per share. Now here's the key to this whole equation. Most people, when they get involved in a stock, they look at their portfolio, they say, okay, I have this much to spend, which is buying power. And they shop based on how much money they have in their portfolio. So what this formula also does for you is it allows you to calculate the number of shares. We call that sizing the position. So if I buy a stock and I'm willing to let it go $2 against me, how do I determine how many shares I get to buy? Well, I take the risk amount, 1,000, divide that by the risk per share, which is 2, and that tells me I get to buy 500 shares of that stock.
Oh, I see.
So you're not overspending your account.
Okay. Well, so in general, though, just to wrap it up simply, what you're saying is that you really have to limit, you really have to have an amount that you're willing to lose in your mind.
Predetermined.
Predetermined. And you really have to stick with that, right? You can't really just
Well-
say, okay, let me ride this a little long. I mean, you're saying now, well, of course it doesn't hit the support level, blah, blah, blah. Let's say, putting that aside, right, in general, you have to limit your losses, right? Because sometimes you're going to be
Yes.
right and sometimes you're going to be wrong.
That's exactly what you have to do, and that's the challenge that most people have. And in not knowing how to manage your losses or even how to size the position properly, you're subjecting yourself to what could be a catastrophic loss to your account. Because remember, it only takes one bad position
Right.
to lose what you have in that account. And again, some people say, I could buy 10,000 shares, but you lose, $2 on that 10,000 shares, now you're losing more than 1% of your account.
We've been speaking with A.J. Monty on the MoneyShow.com video network.